Welcome to the last part of my setup, part 4, entries and exits. We'll be going over how I enter and exit small cap tickers and how I use trade management and how I incorporate my data. Please check out part 2 and part 3. They went over different topics about my setup, such as setup criteria and how I use data. They've been perceived pretty well from the trading community, so I've been really happy to see that, and I hope this video provides you value as well. Now, before we get into my entries and exits, let's go over some common ideas of how you can use a mixture of systematic and discretion to create ideas for you to enter your own setups. Now, for small caps, I recommend looking into volume blocks from prior days. This is the idea of kind of like a bag holder chart. Fib retracement levels, these have been proven over time to work quite well, and they do still apply to small caps. VWAP is a classic one, pretty much used on every chart for large and small caps, and there is still some edge in VWAP. However, I think it will take some finding to make it profitable, pretty much. Volume exhaustion. This is just the idea of too much volume flowing into a stock and it not having enough buys left, so you're able to short it. Or you can do the other way around, where there's so much volume that you could long it potentially. Price movement exhaustion over a specific time period. This is pretty much like parabolics. Or you could even do parabolics for gappers. So if they move an additional 10% in, let's say, 10 minutes or 5 minutes, then statistically maybe they start to downtrend from that time and you can use your entry and exit based off that. EMAs and MAs. Now, before JTrader, personally, I didn't really believe in EMAs and MAs. However, I think they are actually a really good tool and something that's actually very quantifiable. And you can really definitely find edge in them, and they aren't just some fugazi that doesn't work, in my opinion, at least. Pre-market levels, I think a lot of traders do use pre-market levels. There are some edge in them, but there is an instinctive edge in pre-market levels. You can't always short the pre-market high. And finally, and the most common but difficult to quantify, is daily levels. Now, all of these have advantages and disadvantages, such as daily levels being incredibly profitable when utilized discretionarily with a little discipline, obviously. But what makes a good and bad daily level? Is it the volume? Is it the distance between the wick and the candle body? You will encounter a lot of these kinds of questions as you try to become a more systematic trader, which I believe is what makes you a better trader as you gradually begin to take your trading seriously with this process. This is also something I attempt to help people with on the free calls listed below, as many individuals aren't used to thinking in terms of true and false statements, or even in the coding kind of realm of thinking, where you need to be very numerical and statistical. Now, we went over this in my previous video, but this is my day one gap setup and the different grades and how the different criteria play into that. Um, Now, this is what covers my macro edge. So today we're going to be focusing more on the micro edge, which is the entries and exits on the intraday chart. However, I know this is what makes the majority of my edge, as I know that these produce higher results of a red close. Now, we'll also be going over in the next slide how high of day time is a figure I use during the trading day for trade management and entries. Now, high of day, as shown in this chart, has a relation to red close and green close. So let's briefly go through this of why I use it as a criteria for trade management. This graph depicts the percentage of red and green close dependent on the time of high of day during market hours. The graph plainly shows that a high of day after 11 a.m. is worse than a coin toss, e.g. 50%. Hence, I will very rarely enter after 11 a.m. for this particular setup. We'll never know when a stock has created the high of day until the end of the day. However, I can utilize this information to improve my trade management. If I know that the median time for a stock to create high of day on my criteria is set before 10:30 with a standard deviation of 30 minutes, I can confidently infer that to help me trade management. If I know that the medium time for a stock to produce high of day on my criteria, as stated before, was 10:30, then I can reasonably anticipate that I should enter a ticker between 10 and 11 a.m. with that 30-minute standard deviation. Now I can combine this with my medium spike percentage from open to high of day, plus the potential confluence of a volume block or a daily level or a heat map level on bookmap, times of sales, or really any discretionary element. We will also discuss the balance of systematic entries and discretionary entries in the following slide. Overall, this will allow me to enter a stock with confidence, knowing that the chances are stacked in my favor if I know the high of day, realistically, if the high of day happens at 10:30, that there's, we can see on this chart, there's about a 70, 75% chance um, that we will get a red close. Now the balance. I recently heard this question on a free call with a fellow trader, and I believe many traders are confused as to how to enter a stock using solely data. Simple. Make something repeatable, such as entering it open. However, it does not always have to be that straightforward. For example, I discovered on a specific setup that when entering with a spike percentage of 5%, I can actually make more money than if I just entered at open. Now, this was because my winners are bigger when closing at the close, and I have a bigger stop because it is offset by 5%. Or I can even make my stop smaller to allow me to put more size into this trade to make it a bigger winner. This means that even if I miss all those plays in the open that just dump straight away from open, I can still make more money. I think this example demonstrates that you don't need all the plays to make more money, and most of the time as well, this is how you would go about testing a theory and concept before you actually employ it into your trading. Now, do I only have to enter data driven variables? No. In my opinion, you can employ a 90% to 10% discretionary balance for something that the human eye will always be better at, or it's much easier to replicate than a machine. So this is a great example of like time of sales. Time of sales is something that the eye might be better at, but doing it in a quantifiable way on a machine is a lot harder. Also, another example is like daily levels. Unless you can clearly say what makes a daily level for the code to export, then it will be always better to do it with the human eye. However, I have like dabbled in doing daily levels through code, and it can be done. It definitely can be done. You just have to think about a criteria and really look over what daily levels you're picking and why you're picking them in like a true or if statement, pretty much. Now, this is not to say that you should not try to make everything you can clearly make into an if, true, and false statement in your system, but if it's not possible, it's totally fine, and it's just a finishing touch on your edge, such as using Bookmap to help with entries or perhaps using pattern recognition of your years of experience. At the end of the day, you want to make as many of your decisions have a concrete foundation of stats, so you're not using your gut feeling to enter or exit a trade. Now, just before we get into my entries and exits, I just want to remind everyone below that there is a free 20-minute call. In this call, we'll go over any questions you may have about turning your trade ideas into a data-driven system, or coding, backtesting questions, stats questions, how you get started, and the primary objective of the call is to make you a better systematic trader in 2023, and I will offer you some ways that you could do that. It has been my honor to help many traders such as Michael Goody, Decro, prop traders, Justin Flynn, and many more. So I've been just amazed how well this calls have been going, and it's been great talking to many of you that have even watched my YouTube videos, which I still find crazy that people watch these videos. But I am very grateful, and I hope to talk to you on a call before I close these calls off to the public after the New Year's. Now, my entries and exits. I will use my medium stats of the general startup data set to set my expectations for entries and exits, such as the spike from open and the open to close, medium, etc. Next, I will go deeper and use my Excel dashboard to plug in similar stats of the current ticker that I'm about to trade. This would be the gap percentage, market cap, price above, and pre-market volume. This will give me a more zoomed in view of what I should expect from tickers with a similar trait to the one I'm looking to trade that matches my criteria. Mainly, I focus on the change from open to high of day percentage and open to low of day percentage and the time of both of those. Now, let me give you a quick example. So here you can see the dashboard results. So for this example, I've entered in a ticker with a 500 million market cap or under, 50% gap, and above 10 million pre-market volume and a price above 1. Now, first I'll look at the spike percentage. So I should expect on this current ticker that I'm about to trade that there could be a spike percentage of 10% with a standard deviation of 23.9. Now I know using my spike percentage P&L calculator that we talked about before that I'll be more profitable if I take an entry based off a spike from open rather than straight away at open. So we're going to go under that thesis and we're going to say I'm looking for a spike. Now, this will be the first thing I'm waiting for, as well as an entry ideally between 10 and 11 a.m. As we can see, the time of high of day is normally around 9:37 with a 22-minute standard deviation. However, my overall macro edge is looking at 10 a.m. to 11 a.m. So that's what I'll always prefer. However, on this particular one, that will be in my brain that potentially the high of day can be very quickly from the open. Now, let's imagine it's 10:10 and the ticker has just spiked 15% into a heavy volume block on Bookmap. This is also around the pre-market high. And now from my stats, we can see that there's a 54% chance that it could not break the pre-market high. So maybe I would want to take an entry here because we have kind of all the odds stacked in my favor. We've got the 15% spike, it's 10:10. We get the pre-market high that it's kind of a coin toss with 54%. However, it's still some small little confluence there as well. Or I could wait for additional confirmation. So let's say I wait for additional and then the ticker breaks through my 9 EMA with 1 million volume. Now, from my experience, that is what a weak ticker looks like, and that's going to mean I enter straight away. So that you can see there how I've entered, multiple data-driven statistics with a couple discretionary ones to make my confluence to enter that trade. And obviously, the overall thesis of this is I know these tickers 72% of the time, 91% of the time are closing red, and they're not hitting my 20% stop 72% of the time, which is only from open as well. And I'm entering on a spike, so I have an even better edge, compared to the stats shown. Now, let's say the trade starts to work. However, at 1 p.m., it starts to reclaim VWAP. Now, this would be a signal to me that I potentially need to reduce my risk on this trade, either to a relative high or possibly a break-even stop if my entry was high enough from VWAP. Now, the reasoning for this is that it is not acting as a normal stock would in this bucket for criteria, pretty much, like this dataset bucket to close red. If it continues to push through VWAP and potentially makes a new high of day, potentially at 1 or 2 p.m., then I would obviously know that my odds of this closing red are so low. So if it starts heading that direction, then I will be very inclined to reduce risk or make a break even stop, and that is how I trade manage, at least in the small cap space. Now, hopefully this shows you how I use data, plus my discretion to manage my trades, and why a data-driven approach can be such a great direction for any trader to go through. To try and make all your decisions and judgments based on data from similar events, yes, it won't work all the time, but we already know that from the stats showing a 72% chance of it hitting my stop and also an 8% chance of it closing green. So we know not every time it's going to work, and we also know by the nature of trading that things can be random and they won't always play to the statistics. Now, thank you for watching, and if you enjoyed, please leave a like and share it with anyone that might be interested. Also, don't forget the free call below, and I hope to talk to you soon.